You're watching The Sharpe Angle. I'm Leslie Picker. He's recently been dubbed the Renaissance man of venture capital, not because he invests as if it's the 16th century, more like the 26th century, a futurist fund manager. These times call for crystal balls. So here to help us make some sense of it all is Josh Wolfe, co-founder of Lux Capital with $4 billion under management. Josh, welcome. I just want to start first with kind of... Good to see you, too. I just wanted to start first with your broader read on the markets right now. Do you think that, especially in some of the key pockets of tech and growth, is this just some air coming out of the tires a bit or a full revaluation of the sector?
Well, I think in some sectors it's a mix. I think you've got a flat tire in some sectors. We're looking at probably, in my estimation, a greater than 60% chance that we are in March of 2000 for a broad segment of the market that has been very overvalued. And that means that we're probably going to, for an 18-month period till, say, October 2001, where you saw about an 80% decline in some of the most popular names. And that 80% decline happened by 50 basis points, 1% drops over a long period of time, which was a measure of people's belief, clinging, that this was going to continue. You've had 5-6 years where buy the dip has been the mantra, and it has worked. And I think it's no longer going to work, and you're going to see revaluation across specifically some segments of the market, but largely across high growth tech and speculation and the stuff that we specialize in.
What are you telling your portfolio companies to do in light of this?
3 words: husband your cash. Hold on to the cash that you've raised. We've had companies that have gone public through SPACs. We've had companies that have done direct listings, companies that have gone public through traditional IPOs. The amount of cash that was delivered to balance sheets of Lux portfolio companies and many companies around the world is unprecedented. You've got hundreds of millions of dollars for companies that are burning maybe $10 million a quarter, something like that. So you've got maybe a decade of cash. What you do with that cash now is the most important capital allocation decision that a management team and a board can make. And in our judgment, the most important thing you can do is husband that cash. Investing now, if we are going into any kind of recessionary times, is going to be like spitting against the wind, where that cash is going to be ill-served going after growth. Instead, make sure you have a fortress balance sheet, look at your weaker competitors, consolidate customers, technologies, positions. I think you're going to see a huge M&A boom over the next year. One
of the big aspects of kind of valuation growth in Silicon Valley has just been the amount of capital that's been circulating over the last, say, 5, 6, 7 years. Do you see that slowing down anytime soon, given what we're seeing in the public markets? And will that impact the valuations that companies are able to get, as well as the capital that they're able to get moving forward?
An emphatic yes, yes, and yes. Now, the way that I think about this, there's going to be some segments of the market, again, that are flush with cash. A lot of funds have been raised. We closed $1.5 billion just 6 months ago with a lot of dry powder to deploy. Now, the speed with which we're doing that is going to be much slower than it was, say, a year ago or 2 years ago. Now, in my estimation, what I think is going to cause the slowdown is LP indigestion. Limited partners who give us the money as GPs and other funds, I think are going to slow down. The anecdote I'd love to share is one of our limited partners had a whiteboard. And classically, or historically, they would put on that whiteboard the number of general partners that were coming back to market that they would be re-upping into their funds. Now, that used to be 6, 7, 8 names on a whiteboard. When I was talking to this particular LP, they said, I got to tell you, Josh, right now it looks like a scene out of Beautiful Mind, by which he meant that every square inch of that whiteboard was filled with general partners that were either coming back to market, raising additional funds, thematic funds, larger funds, and he was just absolutely inundated. He said, listen, I've been trying to get into some of these funds for a very long period of time. Now that I've got access, I don't want to lose it, but at the same time, I can't keep re-upping. The percentage of our allocation that historically went into venture capital or private equity has grown. The valuations of many of our holdings have grown. At the same time, public markets are heading decline. So you're getting a denominator effect, which is similar to what you saw in 07, 08 in private equity. And I think that's going to be a very tough situation. LPs are going to say to GPs, listen, we want to invest with you. We just want to maybe delay it a quarter or two. Can you do that? If GPs really value the long-term relationships with the LP, they might delay their fundraising. If they do that, they have to slow their pace. If they slow their pace, they're investing slower. They're going to be more discriminating. Suddenly the syndicate, the group of investors that are looking at a company, are going to see a lot of dislocations. So I think that the next year you're going to see LP indigestion, GPs slowing their pace, companies in the private markets seeing valuations come down, akin to what you are seeing predictively in the public markets.
Because typically there is a lag. Only recently have we started seeing reports come out that companies are willing to take lower valuations as a result of what's going on right now. But at least over the last few years, and especially surprisingly during COVID, many private companies still were able to maintain pretty decent valuations, and a lot of them were able to double or triple their valuation. So you think this time is actually different, and we will see sort of that 2002 period where startups really have to kind of bootstrap it for a while?
I think you had indiscriminate funding across the board, whether that was in public markets because of the structure of the markets, lots of passive indexation, thematic indexes, where a dollar in meant buy indiscriminately. Now a dollar out means sell indiscriminately. In the private markets, you had a flood of people that saw these gargantuan returns that were happening between rounds. Now, private markets are way more inefficient. You don't have short sellers. You don't have the kind of daily liquidity where people are looking at price signals and checks to be able to more accurately value companies. And so in the private markets, the latest valuation is set by the marginal price setter. And in many cases, historically, that might have been SoftBank. That might be some of the large crossover hedge funds that are doing private deals. And they were basically saying relatively indiscriminately, we're going to buy the winner in the company. Does it really matter what price we pay? No, particularly if we have great terms. As Carl Icahn once said, your price, my terms. If you're senior preferred in the capital structure of these companies, you're in a great position. So I do think that you're going to see a situation where private companies are going to go through a discriminating narrowing, meaning the crossover hedge funds, the late-stage growth investors, and even the early-stage investors are going to be way more discriminating, and there's going to be dominated by, I'll give you an acronym, instead of FOMO, fear of missing out, it's what I call SOBs, the shame of being suckered. People do not want to be suckered in this current moment.
I do like that acronym. I wonder if it will ultimately take hold, because I think a lot of investors have been waiting, especially those that that have been in Silicon Valley for a while. I've heard the term kind of tourist investors for some of the public-private investors that do both sides, crossover investors, that they don't expect them to be around for a while. Do you agree with that? Do you think that ultimately we do see people kind of just exit this part of the market entirely?
Well, I think it's true of every industry through time, right? You see a huge number of entrants, then a precipitous pruning as the numbers decline over time. What the wise person does in the beginning, the fool does in the end. This happens within sectors. It happens within investment subsectors. So you saw this, 2002 to 2007 with the rise of activist hedge funds or active long-short hedge funds. Then there was a pruning post-crisis. You saw the rise of venture firms from, say, 98 to 2001. The number of firms in venture went from roughly 400 at that time, sort of late 90s, to about 1,000 until it went cut in half, 500. Now, that still was an increase of 25% from the starting point. Today, you went from about 800 active venture firms just a few years ago to over 1,800. Now, some of those venture firms are sole GPs, meaning an individual person that has raised a $25, $50, $100 million fund. Some are people that were junior people at larger firms that spun off, LPs capitalized them, put them in business. A significant portion of those people will go on and create great firms. It's the very basis of how Lux got started. We started in the boom. We were focused on a rare area that other people were not focused on, and we were one of the survivors. There will be survivors. There will be great investors that come out of this market. There will be great new firms that form, and there will be a significant culling of the herd. I would predict that between 50 and 75% of the active investors in private markets today will disappear within the next 2 years.
Speaking of the herd, but looking more in the public markets, you've also been focused on the impact that retail may face, retail investors, from the recent market volatility. Of course, a lot of people started day trading in the pandemic with stimulus checks at home, using commission-free trading platforms like Robinhood and others to do so. But of course, now we're seeing some serious red on the screen. What do you think is the overall impact of that, especially given the amount of margin debt that's out there?
Well, I think, again, a significant portion of people were able to get drunk on this toxic cocktail combination of the absence of sports betting, the rise, as you just noted, of the Robinhood et al.'s, the fractionalization of shares, the easy participation, growing margin debt, margin accounts. And so you combine that with social media where you had meme stocks, Twitter, FinTwit. It was all this amplification, and people were basically investing because other people were investing ad infinitum. And so the herd was moving, and it was working. Anything that was going up kept going up. Then you had the option traders who were doing this sort of gamma phenomenon, buying deep out of the money calls, causing the brokers to have to hedge and buy, and that became a self-fulfilling prophecy. So all of that stuff worked on the way up, and it had value investing investors and veterans that were looking at this just completely aghast, saying this is going to end badly. And every time that they said that, they were proved wrong. People said that value investing in Berkshire Hathaway and Buffett were dead. Whenever people say that, it's typically a year away from when they're proved wrong, and then you see a reemergence of great value investing investors. So I think that retail is going to get hurt very bad. I hope that people were not significantly on leverage. I've tried to do my part, as I know many others have, publicly and on Twitter and elsewhere, warning people, you have not seen a downturn. March 2020 was not a downturn. That was a 2-week drawdown. March 2000 was a downturn. You had people that were participating in significant RIFs, reductions in force. They were losing their jobs. They were losing their 80% of their stock portfolios. The wealth effect had reversed. They were encumbered by debt. They lost jobs, went back into consulting and banking companies. So I think that you're going to see a similar phenomenon here. And the interesting thing to watch for is when you see the revocation jobs being revoked. So I remember 20 years ago, you had investment banks in March 2000, maybe the ensuing 6 months, that were taking recent grads that had given cushy job offers to at Goldman and Lehman, and all of a sudden those things were being revoked, and that was like completely shocking. I think you'll see the same thing here, whether that's growth equity investors, whether that's hedge funds, whether that's investment banks, where you will see job offers for this current crop of young people potentially being revoked, and that's a really important signal.
What gets to that point, though, because if you look at the employment market right now, I mean, it's definitely an employees market. They have all the leverage, it seems like, in getting a job. So what has to turn for it to get to kind of that signal?
Well, again, today, employees have all the leverage, and they should. They're valued employees, but you have that in part because of the huge amount of money that's gone to create lots of redundant companies. Lots of redundant companies are competing for talent. That demand is driving up wages, increasing the average cost of an engineer, software developer, scientist, technologist. Everybody has seen rising prices and the ability for them to command and demand higher equity portions. If and as those companies start to die, meaning the capital dries up, rounds get smaller, there are rifts and layoffs, and suddenly people are seeing that culling, then suddenly you'll see this reversion, as you do, between the pendulum swing between labor and capital. And I think that in a year or two, the most valuable engineers will still be able to command premium prices, but you'll see a normalization. And again, just like in the public markets where you'll see discriminating between active investors and passive investors, you will see discrimination between really excellent engineers and entrepreneurs and the not so great ones.
Given that backdrop that you outlined, are you putting capital to work right now? Are you kind of hunkered down to see how this all shakes out? Or are you really just looking to sit this out for the long term?
Well, for our existing companies, we've got fortress balance sheets, and we're telling them consolidate your position, do it as quietly as you can, do it as loudly as you can, but just do it. For new investments, we're becoming more discriminating on price. We're not participating in any auctions. We're not doing deals that are closing because of this FOMO in a day or two because you've got 40 competing term sheets. We're playing the long game. Now, the beautiful thing about the long game is you can invest in deep science and deep technology in these cutting edge areas where there are few investors and few companies. We're not investing in areas where there's 500 or even 50 competitors. In many cases, we're investing in a sector where there might be only 1, 2, or 3 companies. You capitalize that company, you bet on the right management team, and you can withstand whatever's happening in the macro for 5, 6, 7 years and make sure these companies are well capitalized. At the end of the day, we're not buying indexes. We're not passive investors. We're active investors. We're sitting on boards. We're helping grow these companies from inception, providing them talent and competitive intelligence and future financing risk reduction. I always say that it's sort of like in our business, trying to pick the best meal on a menu. After you've selected the best menu in the best restaurant, in the best city, in the best state, in the best country, and you're about to eat a morsel of that delicious bite that you've selected, and all of a sudden Godzilla comes and steps on the restaurant. Ignorance of the macro is no virtue. You have to pay attention to what is going on in the context of capital markets, inflows, price setting, where money is flowing. What the Fed is doing. A lot of people are not focused on that kind of stuff. We historically always pair a little bit of macro understanding and the global situation into our micro investments and security selection on the entrepreneurs we're betting and the companies that we're building.
Do you see any specific opportunities right now that you're excited about?
There are 2 big themes that we're really capitalizing on, and we broadly say we're prepared to pounce. So one of them is in hard power, and one of them is in soft power. Both of these relate to geopolitical instability. In the geopolitical stage, you've got a revanchist Russia, you've got a rising China, you have a Cold War really between these 2 powers, a bifurcation of financial systems, surveillance systems, internets, technology. And so on the hard power side, every facet of aerospace and defense is something that we think the U.S. and its allies needs cutting-edge technology. You've had 20 years of a zeitgeist where people have really been loath in this military-industrial complex to want to provide cutting-edge technology to the women and men that are on the front lines of war, whether that's special operations, Air Force, Space Force, Army, et cetera. And so we are very focused on providing technology through many of our investments. to the defense industry. And I think you're going to see a resurgence and a reemergence of some of the next-gen primes, the people that are going to compete with Lockheed and Raytheon and General Atomics and all, in air, space, land, and sea. Autonomous systems, artificial intelligence, machine learning, cutting-edge tools and technologies that are very expensive, very risky, and in many cases, people have been loath to only focus on a government customer like the Department of Defense or the Pentagon or our allies. We're entirely comfortable doing it, and we think it's geopolitically important. So that's the hard power piece. It touches space, aerospace, et cetera. Space itself, fascinating segment. You're seeing a lot of competition geopolitically and globally. You've got north of 14 sovereigns that are now racing to get to space. You have areas of competition like the International Space Station, which historically was a great forum of extraterrestrial diplomacy between Russia and the U.S. The U.S. went to Russia, said, hey, let's do a lunar base. Russia said, nope, we're doing it with China. And so there's a lot of competition to launch things into space, to have satellites, antennas, communication, lots of technologies that we're invested in across that platforms, from literally launch all the way up through space. On the soft power piece, and this is really interesting, historically, the U.S. and its foes competed on the global stage by a few different ways. One was export of amazing American culture, Hollywood, movies, music, entertainment, MTV, et cetera. And then it was also competing on the stage for sports and science. Sports was Olympics, Dream Team, Team USA, et cetera. And science was winning Nobel Prizes and major breakthroughs and discoveries. The thing that proves that enables breakthroughs in science and soft power are cutting-edge technologies that the scientists use. Microscopes, lab automation, software to improve R&D. So we're convinced, and people have not really picked up on this theme yet, that what we call the tech of science, there's going to be a huge boom and demand globally, but particularly for the U.S. Pharma companies, biotech companies, academics, U.S. Government labs, for the technologies that improve science and give us a competitive advantage to win on the global stage, what is really prestige globally.
Fascinating. The plumbing of scientific discovery. Well, we now know why you are called the Renaissance venture capitalist, so we appreciate you taking the time. Josh Wolfe, co-founder of Lux Capital, thank you very much for joining us.